So what does this move away from the traditional safe haven asset tell you about where the market is heading, Tim?
Well, if they're vacating Treasury assets, you'd think yields would be higher. So, I mean, I think some of that is somewhat conflicting. But I think the confluence of ECB last week getting out there saying, hey, I think we're done in the short term, even though inflation is a little sticky, it's kind of not moving anywhere. And I think at this point, their dovishness relative to the Fed is yesterday's news. I think post CPI this week here and some Fed commentary and some sense that the markets are pricing in at least now 2 cuts before now and the end of the year and possibly a bunch next year. You've got central bank differentials, which are really, I think, putting the dollar in a place where the dollar could weaken that much more. And I think often that is really the number one driver for the Dixie, which is that euro basket cross, and then you have the yen. So I think it's a combination of that. I think some of it is trade tariffs in the U.S. economy. I think is growth differentials between us and Europe that have contracted. In fact, you could make an argument in Q1 GDP, which is always backward looking, but that actually the EU on a relative basis was stronger than the U.S. I think what it means for markets is it actually could be very good. I think it's not bad for U.S. multinationals. We always talk about that number. I think it's certainly very good for industrials. I think it's great for commodities, especially industrial metals. And I think these are trades that were kind of picking up steam anyway. And I don't think it really hurts technology because I think a lot of these technology companies are well insulated from the inflationary forces of a weaker dollar. So net, I like it.
Or should we question, doesn't it matter why the dollar is moving lower? And at what point will that outweigh the dollar weakness being a good thing for multinationals?
Well, I don't know. We were talking a little bit about this before, and Tim brought it up. It's a little perplexing to me that yields are lower, so Treasury's stronger, and the dollar lower. So I don't know. Maybe
it's not foreign outflow.
What? You don't think it's?
Sorry, I don't think it's foreign. I think what you're saying is
there would be a sell-off in Treasuries as well, and yields would be higher,
and that would make more sense. So I'm not really sure as to when the dollar was going the other way, and you would have the multinationals have a hit when they talk about constant currency earnings. I always sort of dismissed it then, and I'll dismiss it now. That
who cares?
P&G brings what?
Who cares?
Who cares that they made it on dollars?
I'm sorry, I thought maybe that's what you were saying because I don't typically care.
I always,
that would have been rude if he said it directly at you. Who cares? I don't think
that's all right. No, I don't really like that as our earnings are better because the FX was better. So.
Yeah. I just think that Tim mentioned the growth differentials. We've seen this now twice in the last week and a half, though. We saw OECD and we saw the World Bank this year. And it's interesting when you think about the uncertainty here, and if you talk about foreign flight of our assets. I mean, you really are seeing pressure on our growth, at least the expectations of that, relative to these other countries that we put these tariffs on. And the idea that you might have a protracted trade situation, it really does. I mean, the idea of capital flight makes perfect sense. It's kind of the opposite of the carry trade that we've seen unwind here and there, right? Like, I think folks are looking for higher yielding places other than the U.S., especially if you think that growth is going to be weaker here than abroad. So, I mean, to me, as far as the yield thing, when you think about quantitative easing, what are they trying to do? Normally, they're trying to get yields down and they're trying to get the dollar down. And I think that discrepancy that we've seen over the last 2 months, maybe it's coming back more in vogue or more the way it should be doing. But if you do see that stuff going the opposite way, I don't know how you would kind of take what the equity market is doing, climbing back towards those prior highs, and not be more concerned about what's going on in the dollar and then that kind of disconnect. Because if you have a weak dollar and you have stronger yields and then you're starting to price in, slower growth, that's not favorable to equities, no matter what you think a good dollar or a soft dollar is for S&P earnings.